My name is Yarthi, and I am Assistant Manager at Digital Marketing at RNM. I request you all for active participation throughout the webinar. If you have any questions, you can please share them in Q&A box. Now, I would like to hand over to Mr. UN Marwa, who is Senior Partner at RNM, for welcome note.
I'd like to welcome all of you on this panel discussion on how the union budget is going to impact you, which is being organized by RNM India. As you are aware, RNM India is a consultancy firm operating in Delhi for the last 75 years and having branches in Gurgaon, Raipur, and London. This webinar is meant to be a roundtable discussion regarding how the union budget will impact you. The discussion is meant to address the various aspects of the budget and its possible effect on different industries. Before we begin the webinar, I would like to introduce and convey my gratitude to all the panelists who have taken their time out to share their experiences and expertise. Welcome, Nishant. Nishant has over 17 years of experience in a global conglomerate. He is a vice chairman of JVM Group, which is a 2.2 billion global with operations in more than 25 locations across 10 countries throughout the world. It is among the world's leading manufacturers of key auto systems, electric vehicles, and buses. Welcome, Nishant. We have another panelist is Nitin Shakkar, who is a professional institutional investor. As the founder and CEO at the Green Capital single family office with the core focus on private investment, public equity, debt, private investments, venture capital, real estate, and investment research. Welcome, Nitish. Nitish leads the indirect tax practice and has over 20 years of experience in indirect taxes and WTO laws advisory, compliance and consultancy, and India tax reforms about GST. He has advised large multinationals and Indian corporates on structuring transactions, supply chains, and business processes to optimize the indirect tax incident, as also providing litigation support. Welcome, Prakash. Prakash Jain has 15 years of experience in the field of corporate and international tax and GST laws. He advises domestic and multinational companies on various tax matters. He's presently located in Bangalore, heading the Bangalore office. Right? Last but not the least, I would like to introduce our host, Raghu Bhargava. Raghu is the CEO of RNM India and is leading the firm. His expertise in his advising and structuring businesses overseas on behalf of Indian corporate clients, entry strategy for foreign clients to set up businesses in India, transfer pricing and overseas taxation matters. I would now like to hand over to Raghu to moderate the ensuing session. And I'm confident that the panel discussions would be enlightening and thought-provoking to all participants. Thank you all and welcome. Please, Raghu, I'd like you to take over now.
Thank you so much for those kind words, and welcome everybody from me, Raghu Marwa, your moderator today. We have in the past done 5 how-to series of master classes which cover various issues faced by startup founders in their journey and the alternative investment options available to investors, including the hot topic of cryptocurrency and NFTs. Before we start on the current topic of how the Union Budget 2022 is going to impact you, I would like to quote from the Tamil poet Valluvar Thirukural 385, where he had said, "A king or a ruler is the one who creates and acquires wealth, protects, and distributes it for common good. This particular Tamil poet is a favorite of our finance minister, Smt. Sitharaman, and she has quoted this widely in the past. So I thought it would be a positive omen to start this session with. One would ask why the union budget is important and what exactly is a budget. To break it down to a simpler thing, a budget is defined as an estimate of income and expenditure for a set period of time. And obviously in India, the budget is presented from April to March. And when it comes to the union budget, every person has a view to express on how the Honourable Finance Minister should do her job, because the goal of achieving common good or dharma is fraught with uncertainty and subjectivity. The budget also has a very wide impact on each of us in different ways. Today, we're going to hear from my experts on the nuances of the industry impact, as well as some of the significant technical issues. On the automobile sector front, we're going to hear from Nishant about the 4 priorities which announced by the budget of PM Gati Shakti and productivity enhancement and investment, energy transition, how they're going to be the force multipliers, which shall in the coming years lead to better roads, greater EV focus, and the PLI scheme, which has also been a huge success for the auto sector. On the capital market front, we're going to hear from Nitin, who's going to be talking about the priority that the government has given on financing of investments and the 35.4% increase in outlay towards capital expenditure in the budget, and how that's going to lead to a party for the individual investors and the family offices, which is, the caveat being the geopolitical current tensions are obviously bringing down the market, but that's, I think, a topic for a different webinar altogether. The contours of the digital rupee is also keenly awaited, and its success will give a fillip to the digital economy, including fintech sectors. On the direct tax amendment, we're going to hear from Prakash, who's going to be talking about the he's going to be talking about a deep dive into the few of the significant changes around the tax on virtual digital assets, education cess disallowability, and its impact on you, the impact of tax on dividend received by Indian companies from their foreign subsidiaries is also another ticklish area which we would like to cover. On the indirect tax amendment front, we're going to hear from Nitish, who would like to examine in greater depth the budget impact on input tax credit, ITCs, and the refund of taxes, as well as the custom administration changes in SEZ, which is likely to significantly improve the ease of doing business in an SEZ. On the regulatory front, the CPACE, which is the Center for Processing Accelerated Corporate Exits, is to facilitate voluntary winding up from the present about 2 years to a 6-month period, which is something which I think is a really welcome change. So with that, I'm going to start off by inviting our first panelist, Nishant, who, Nishant, you are obviously on the cutting edge of not only the auto sector, but also the entire EV journey. So I want to, first start off from you and understand how you feel the future of the EV sector going forward in India is, and what is the positive impact as per you that not only the budget will lead to the EV sector, but to the common man as well. Over to you, Nishant.
Sure. Thanks, Raghu. Happy to be here. I think it's a very opportune time that this discussion is being held. And because at this juncture, we are at the cusp of really taking off as an industry. And we have all the right ingredients here. I think during COVID, all of us have really understood the importance of health and environment. And it all comes from us as individuals. And when we see it from individuals, so the individuals lead to the family and the society and the country. And at a national level, when we see it, in addition to health and environment, we see that what impact it can have upon us if such issues come up. So when we see that perspective, we also understand that it is not only a matter of individuals, but at the national level, it's a matter of energy security. Today, we import majority of our energy requirements from different countries across the world. So it is very important that how we create an ecosystem which is self-sustainable. how we as a country are able to attribute our resources in that direction. And that's why I always believe in a concept and a system which we call well to wheel. So from the oil well to the vehicle wheel. So from generation to consumption. So how we start with renewable energy, and now India has targeted a 500 gigawatt by 2030. And when you look at renewable energy, so you generate green, and then you have where we have abundance of solar, wind, hydro, waste, about 62 million tons of waste. So which helps us create a circular economy as well. And on the other hand, we are seeing that after the generation, we have the right distribution network which is in place, and charging infrastructure is put in place with the right set of electric vehicles. Today, most of our customers, most of the users look at different aspects, but I would just touch upon few of them linked to affordability, safety, and luxury ride-like comfort. I think that is most important today, where a customer, where a user feels that how the noise pollution, which is a constant part of our lives, is not there. Where they see that with every single vehicle, if I take example of an electric bus, we are able to knock off 350,000 liters and about 1,000 tons of CO2 from the environment. When we look at such kind of things, today 22% of the pollution is caused by vehicles, when the density is less than 30 vehicles per 1,000 people at a passenger vehicle segment, which is going to increase to about 65 by the end of this decade. And it will contribute about 35%. So we have to catch it at the right time for it to be addressed. And today we have a clear clean energy program where about half terawatt, so about 500 gigawatt is there, for which our Honorable Prime Minister has ensured that India is the global headquarter of the International Solar Alliance. So when you are addressing the generation side, so on the consumption side, we need to see that how the right set of electric vehicles come in. And that is where the play comes in with the demand and supply. When we talk about the supply, so competitiveness is very important. Competitiveness is driven by scale. Competitiveness is driven by the design and the creation and the development of technology which companies do in their R&D centers. And how is that real time? And this does not a cut copy paste from any Western or Eastern economy, which is brought to India, because India is a unique market, and how it is made for India, and you are making for the world. So when I mean scale, I don't mean that you only produce locally for the local market, but you produce locally for the global markets. Because in case of electric vehicles, the other benefit which you get is that the emission norms, which are different in every country, the boundaries are erased, and it becomes a seamless integration. And when the local manufacturing happens, so schemes like PLI really incentivize companies like us to invest substantially and see that India becomes the global EV powerhouse. On the other hand, when you see the demand, so government of India launched FAME 1 policy, then they had FAME 2, which got extended recently by a couple of years to FY24. And there, the FAME 2 policy also lays out a very clear a roadmap how things can happen. So it is not going to feed 100% of the electric vehicle requirements, but it is acting like a true catalyst in making things happen. So on the PLI side, we see more than $6 billion, which is the highest allocation in PLI for any segment, which is meant for the automotive components and batteries, which is all meant for electric vehicles primarily in this case, which was a big change from what was there before. So I think that clearly is a testimony of the fact that how India is having a real commitment to net zero 2070. And personally, I feel that if we keep moving on this path and we are focused on sustainability, so then by 2050, we make it happen. Today, I see a lot of people from the finance world here. So if I look at that from that perspective, so we see that today we are trying to see that how sustainability can become profitable. So how I look at it is that if sustainability can become profitable, then profitability can become sustainable. So that is the key element which we all need to understand. And when sustainability is profitable, it becomes scalable. When it is scalable, it becomes competitive. So because what is clear is that the end consumer today doesn't understand the electric vehicle very well, and it does disrupt and change the operating pattern of the end customer. So it is a business imperative that how we ensure that the market dynamics are such where the end customer, whether with the charging infrastructure, they have range anxiety, they think about the battery life, the resale value, the insurance, and whether they use public transportation, they think whether the vehicle will stop on the way, something will happen to them, how comfortable it is. But when they use it, they really understand that's a noise-free experience. It is a luxury ride-like comfort. It's affordable, and it is something which they should have done much earlier. Definitely, there's a price parity gap today, which would get addressed in next a few years. And that is exactly what happened in solar as well and other renewable energy sources, where initially they were subsidized for a few years and they have become self-sustainable now. And as individuals, I think India is really moving forward at a very fast pace, where the technology redundancy risk has to be addressed, and companies are investing in technology and are really looking at that. When we look at such opportunities, the whole ecosystem is what is most important, because no company individually can do it, and it's all about collaboration. So different companies across ecosystem, like we have developed more than 25 companies in India for manufacturing EV components and systems, not only for us, but for export worthy technology areas. So which has been very meaningful. On the other hand, we are clearly seeing that there's a dearth of people who are skilled today, because there's a lot of new technology involved in this, and a lot of learning, unlearning, relearning will happen. As a country, there's a big focus on the Ministry of Skill Development for apprentices, for engineers and other people. So how to make them employable, how they're industry ready on the day one, I think that is something which is going to be redefining the market dynamics in the future. And we all need to understand that. So I think these are certain key imperatives. If I look at the budget, I think budget has been very forthcoming with the enhancement of solar PLI, with the battery swapping coming in, the focus on energy storage, the focus on really seeing that the Gati Shakti brings in the right infrastructure across the country, and not only for road transportation, but all different modes of transportation. And each mode of transportation enhances competitiveness, because we use that for transporting our vehicles. We use roads for the movement of vehicles, and not only commercial vehicles, but all kind of vehicles. And people are seeing, like now with the new expressway between Delhi and Mumbai, the journey would reduce to close to 12 hours, which used to be 24 hours at one point, became about 17, 18 hours, and now it may reduce to 12 hours. And in future, it may be even lower. And we see that in certain areas, India is benchmarking other countries, where we could have probably electric highways or expressways where the vehicles could charge on the go. That is definitely not happening today, but that is few years down the line, which could really drive the economy, which could drive the competitiveness of those trucks and vehicles in a big way. And at the same time, we see that hydrogen is also picking up very well. And hydrogen electric don't compete, they always complement each other, because both have different skill sets and USPs, with which FCEV could also be a reality in the future. And I see that by about 2030, we should be looking at a majority of electric buses, majority of two-wheelers and three-wheelers being electric in India, and close to 40%, 50% of the new vehicles in the passenger vehicles being electric in India. At that time, when we see this, there are a few more expectations which we all had from the budget, in terms of incentivizing Make in India is very important, because that gives skills and sustainability. At the same time, there's a huge amount of investment happening in technology. So how the technology funds can be created, which was there earlier, for companies who are investing in technology locally, to incentivize them and to motivate and inspire them to invest further, and see that how local designs, engineering, which is a recurring activity, especially in electric vehicles, because the risk of redundancy is very high, the changeover of technology is very high, and for companies to be motivated to do that is critical. On the other hand, I mentioned about skill. So skill is very important, that special incentives and setups are given. Skill development centers are being set up by companies like us. We've set up multiple parts of India and abroad, where we are developing and engaging these people with real-time challenges, so that they are industry ready from day one. But how can that be institutionalized, where there is an industry, academy, and government partnership, and things are brought on board in a manner that they really define the youth of tomorrow. On the other hand, it's very important that I look at it, if I summarize this in 6 parts. So first part being the manufacturing and the scale and the sustainability, which we have discussed. Second being the skill. Third being R&D and technology. Fourth being the power infrastructure. So we need to strengthen our power infrastructure, our discoms and our distribution networks for it to succeed. Even though there is a myth in the industry today where they say that what kind of power requirements are there, if today 30% of the industry converts to electric, our power requirements would enhance in a single digit, which is 7 to 10%. So it's important to understand that part as well. Then the next point is regarding the availability of priority lending, because in this sector, we see huge interest from VCs and other people, and it is very fashionable in certain cases, if I may call it, to invest in electric vehicle companies. But priority lending and the right structure for startups, for MSMEs, and for larger corporates is very essential at this juncture for us today. And there's a lot of collaboration which is happening. So nurturing all three independently is going to be instrumental in redefining the markets of tomorrow. I think that is what is most important. That is what we need to understand really in this case. And last but not the least, with our focus on net zero 2070, we have one sun, one world, one grid as well. So how are we ensuring that we are not only powering the EV revolution and the transition towards the zero emission technologies, because the focus is not only EV, focus is zero emission technologies, and EV is the most promising zero emission technology today. So how we as a country are really imbibing a structure where we can really
I think we have had some technology issue with Nishant, but I think all the points that Nishant raised, I have been amazing. I think he's touched upon from manufacturing, scale, R&D, lending, power. I think every facet of the electric vehicle and the sustainability journey that India is going to be going on. And with that, I'm just going to add two more things that we've got Nishant back. I think, Nishant, while you were gone, we were just saying that, you've touched upon almost every aspect and more. And, the follow-on question that I had seems to have already been answered by you, where I was going to talk about, the recent 1 million units as per, the Society for Manufacturers of Electric Vehicles. They've announced that they're probably going to hit a 1 million unit target in 2022, which is kind of unprecedented for India in the past. And so we are obviously on the right journey, but in a country of 1.3 billion, 1 million units of electric vehicle is still obviously quite a small number, and there's a big room for us to improve in that. And especially with, like you talked about, Prime Minister Modi's commitment at COP26 and the kind of changes that we want to see as a country going forward. There's obviously a lot that can be done to enhance adoption. So I think what you mentioned seems to be the right answer. As long as it is economically feasible, that's the simplest way to, get adoption. But any last thoughts that you would like to make on that point, Nishant?
So one thing is very important, that the organizations in India for enhancing competitiveness would need to adopt new technology consistently, as we are seeing. And just a couple of things to wrap up. I think one thing which we need to imbibe as a country here is something which I learned from Israel always. I'm there. Fail fast, fail cheap. So that if any technology is not working out, how we fail fast, fail cheap, and then we move on rather than dragging it and not creating that as a taboo for companies in India today. In Israel, what I understand, majority of the funding happens to those entrepreneurs who have failed in the past because they know what success would taste like and the importance it has in the future. Whereas in many countries like India and many others, people who fail become untouchables for some time, if not for their lifetime. So that is one. Secondly, we need to be clear that any technology of yesterday, we can't really see, like in auto industry at times, we see that one technology lasts for 5, 10, 15, 20 years, because what got us here will not take us there. So we need to be very clear about that. And thirdly, my point is companies looking at the EV sector should not look at short term, should look at medium term to long term with a clear investment pipeline and product portfolio or service portfolio, depending what they're trying to contribute to. And looking at the whole ecosystem, because the industry is not about competition, I look at it as a co-opetition. So competition and collaboration at the same time, and really working together and seeing that how things can evolve as we move forward. So these things would be instrumental in working for the industry. And when you talk about the cost and other fundamentals, the industry today runs on total cost of ownership. So it's not just price. So total cost of ownership is what is most important in case of electric vehicles in redefining the dynamics as we go forward. And that is why you see that many wet lease, dry lease, and other kind of contractual structures are there in the EV industry, which work very well. Because the operating cost is a fraction of the existing fossil fuel or conventional fuel based vehicles. So that's all from my side. Happy to answer any questions now. So thanks, Raghu.
Thanks so much, Nishant. That was very exhaustive. I'm sure there'll be lots of questions, but as Shivanjali may have said, we're going to have all the questions being answered at the end. And just as a reminder to everybody who's joined us, please put it on the chat group or raise your hand or put it on the Q&A section, and we'd be happy to get the panelists to respond. With that, I'm going to switch gears and invite Nitin to give his thoughts on the budget from a capital and a capital investment point of view. I know there's a lot of funding which is waiting on the edges to get pumped into India. And, like Nishant said, it's obviously fashionable to hold stock in Tesla and other companies. But how is it from your perspective, and how do you look at, the budget helping the capital markets? Over to you, Nitin.
Hi, good afternoon to everyone, and thank you, RNM, for having me over. So I'll try to break it down with a personal example, because capital markets, what are capital markets? At the end of the day, it is a business of identifying an opportunity, and the budget just gives us a guide path to identify the sectors and the opportunity where we think we can create wealth for ourselves and for the society at large, right? Now, 20 years back, when I used to be in the markets as a trader and investor, it was qualified as speculative. So what are you doing? You're doing a speculative business. I think the capital markets and the investment industry has matured so much over the years, and a lot of the credit goes to all subsequent governments, why only this government, in a sense that today it is qualified as a business. It is qualified as a way to make wealth for individuals and institutions, right? And if I correlate that to the budget, I'm happy about 2 or 3 things in the budget, and I'll sort of point them out. One is the fact that the government has given recognition to newer forms of investing by applying a certain tax rate. Now, obviously, it means that it is open and government is innovative enough to consider certain newer technologies. That is one. Second thing is very important is the government has been very smart in identifying 4 or 5 main key sunrise sectors, as I call them, namely, let's say, agriculture and technology, automation, robotics, drone systems, emerging electric vehicles and infrastructure, also in terms of clean energy and management, waste management. So, if you look at the sectors and industries that we have in the current economic sphere, we have pharma, we have chemicals, we have old manufacturing. But I think the capital markets, the prime objective is to showcase newer and newer sectors for people to invest in. Newer companies should come to the market. Younger, stronger entrepreneurs should come in for innovation, because ultimately, what do the capital markets stand for? They stand for innovation and growth, right? And it is also the creation of asset pools. So, even in the Indian financial capital markets from different budgets, the third point is taxation. Now, that really impacts us quite a lot, because I still feel that as investors, we tend to pay a lot more taxation than we should be paying. Even as personal examples of UHNIs who are earning more than 1 CR, 2 CR, they're taxed at a very substantial rate. So considering we pay tax at source, considering we have also started paying tax on dividends, I think there has to be some model which creates more benefits for more and more investors to join the equity pool. I don't have an answer to it, but NPS systems or tax loss harvestings, or in terms of reducing STTs, because there is a lot of double taxation that we pay as equity investors. So I think those are the three key points in my view. Now, in terms of capital markets and the budget, what is very interesting to note is the government is moving towards, and this is not a trend which has witnessed over the last 4 or 5 years, is businesses which are benefiting the society a lot more are getting a lot more infrastructure and financing support. By that I mean, businesses like waste management, businesses like solar energy, businesses which create infrastructure, defense and security for the government at large. Whereas businesses which are in old traditional economics are not necessarily really creating a lot of value for society, or known as sin businesses, as what we call it, let's say tobacco and alcohol, are possibly businesses of the old and not necessarily something that we should bet on substantially, because the government seems to be following a lot more economic models of certain countries from EU in capital markets, and certain countries of Scandinavia. There's a lot of push on clean energy. There's a lot of push on sustainability. I don't know if you read, recent news says that by 2024, Paris will ban cars in the metropolitan city. No cars will be allowed in Paris by 2024 inside. So that's a huge exercise and goal to how to create better societies, how to reduce investments, how to stop pollution and things like that. So I think the government is cognizant of that fact, and budget is just, in my view, it's just a guide. Government cannot handhold you to explain to you what you should be doing with your life, how you should be saving taxes, where you should be investing in. The idea is to create a budget, to create an exercise, and to not tinker around too much is also very important. So I think in this budget, the government has not tinkered around too much, which is always a pleasant exercise, and at least it creates continuity for investors, and not only us as individual investors, but also foreign investors who deploy a lot of significant capital in the Indian capital markets. And the Indian capital markets are so deep that we have very large issue sizes coming to the capital markets. There will be LIC, which will probably be the largest issue India has ever issued. And that will probably be a true test of liquidity, because capital, unfortunately or fortunately, it's a lot on liquidity. And once there's abundant liquidity, the financing and the money capital goes to companies and investments. So I think investors should also note that liquidity is also a very important part of running a sustainable business. There have been instances on higher valuations on certain technology. I think it's changing around back to growth value. So, it went to growth. Everyone thought that growth businesses and loss-making enterprises were the only way to sustain. But I think sustainability is not that. Sustainability is still your bottom line is, sanity, and the top line is still vanity in that sense. So I think every investor should also, as a personal example, should think of themselves as their own individual company. What are the income? What are the expenses? Where are they investing in? What did they do last quarter? How have they beaten their performance over a company's performance? And it's very important to equate your own finances as a company's finances, and then see how tough it is to manage a quarter on quarter, and try and equate that. So I think what is also important is, I feel that many individuals and smaller SME companies will set up a lot of more company structures for tax liability. So I think there will be a lot of one-man owned company outfits, LLPs, private limited companies, which will come into the fore, because I think we need as investors, we need to have different vehicles to invest with, because every investing vehicle gives a different tax output. So I think that in a nutshell is possibly my personal experience with the budget. Happy to answer any discussions or questions that we have.
Thank you so much, Nitin, for that. I think I just have one follow-on question for you, and that talks about I recently the startup and the startups getting listed is obviously something that gets a lot of headlines these days. And then on the other side of the spectrum, you have a lot of startups who are choosing to remain private. who are not choosing to get themselves listed, because there's so much of funding chasing those large level startups. So, and then there is this huge ecosystem of angel investors, which has got built up in India over this time period, talking about the investor pool side, and who have now got portfolios which are, in triple digit, it's not, that their portfolios are any small portfolios. They could be, although they are angel investors, they could be, matching the size of a lot of institutional kind of boys as well. So do you think that this whole startup scene and the whole incentive, so to speak, that the government is trying to give startups really a free hand in India, and trying to reduce the doing business challenges that startups have, do you think that that is going to be really a game changer for the capital markets going forward?
See, I think the startups is a very huge space. Just to quantify it, we all hear the headlines of a Zomato or a Nykaa or a Policy Bazaar coming to the public markets and listing. But it's very simple that once the startup accesses the public markets, the scrutinies are higher. The valuation exercise which you can pass through a private market, the public markets can be quite brutal. And we've this it plays out every 10 years by default. It played out in 2000, 2002 in the boom. It plays out in 8 and 9. It's again playing out. Is that technology investments over the last 10 years have given significant returns to investors. Now, why does the company access the public market? It is very clear that some of the issues were actually exit vehicles for a lot of the institutional investors, and they don't leave too much on the table. So once they come to the market, the valuation drawdown can be quite painful. And I don't think we've seen complete drawdown yet. This pain will last for 1 to 2 years till the time there's complete capitulation in technology investments. Money is actually not moving so much into technology, actually. The money world over and in India is actually moving to traditional businesses which have significant cash flow. Because every rotational cycle of capital markets decides that, yes, there's exuberance in a certain space, and yes, there is value in a certain space. So even traditional companies will get far more access to capital. It will be a bit tough for startups. I personally think I could be wrong, but I think for the next 1 2 years, it's a bit of a tough ride for startups coming into the equation. What the government needs to do from a capital markets point of view is government should identify the way they have identified MSME, SME in the traditional businesses also. Not everyone can be a unicorn, and it's very failed to explain how to be a unicorn. Everyone can run sustainable smaller businesses also, but they need to have access to funding. So if you have the NIF structure, which is a very large fund, and the government has a lot of gift city or initiatives on that, I think the government should start investing from the NIF fund into smaller SMEs, MSMEs who are in the startup space, so that NSE, which is the Emerge platform, which does allow listing of smaller issue sizes, 20 crores, 100 crores, 200 crores, 300 crores. That's how you build the ecosystem. You cannot build the ecosystem by just doing large issues of Zomato, Nykaa, and saying that, oh, technology has found its course. If you really want strong technology, you have to start from the ground up and get all the firms who are even smaller in size to start exploring capital markets, because that's where they can build the wealth and pool and regulation and everything. And I think it needs to be following the format of SME, SMA, even in the startup space, because not everyone has the ability to scale up. And there is no saying that every successful business does not mean that it has to scale up. A successful business means it has to generate net profitability. And as simple as that, it has to generate revenue. And if you're net profitable, you're a successful business. That's the end bottom line.
Absolutely. Thank you for that, Nitin. We're going to shift gears to Prakash, and we're going to dive into some of the taxation nitty-gritties. So I hope you all guys are all ready. The first question for you, Prakash, is with the government taking a very bold step of defining, recognizing and taxing virtual digital asset transactions at the rate of 30%, what do you think is going to be the impact? Are people still going to try and dodge that bullet of paying that 30% because it's so high? Are they still going to quit, try and, the carry forward loss, the brought forward loss issue that is emerging around this, virtual digital asset? Why don't you share your thoughts upon this change and what could be the kind of positive and negatives around this? Over to you, Prakash.
Thank you, Raghu sir. So we have seen this budget. Generally, it has taken the steps for the revenue mobilization. So they are bringing this crypto tax into the picture. So what is the crypto tax and how they have defined the virtual digital assets? That is the important aspect. So they have defined the virtual digital assets intra alia, a code or number or token, not being an Indian or foreign currency, generated through cryptographic means or otherwise, and also includes non-fungible tokens or any other type of token. So they want to tax all these kind of tokens at the rate of income from virtual tokens means income from virtual digital assets. They want to tax at the rate of 30%. So while taxing this at 30%, what are the deductions which will be allowed? So they are saying the cost of acquisition will be allowed as a deduction. No other deduction will be allowed. So now here the pondering point is, what is the cost of acquisition? The cost of acquisition is only the inherent value of the virtual digital asset, or whether any ancillary or incidental cost will also be allowed as a deduction. So they are not clear. They are saying only the cost of acquisition will be allowed as a deduction. Now, second thing, they say loss on transfer of virtual digital assets will not be allowed for set off or carry forward purposes. So what is the crux in this? Well, the finance bill has provided that no set off of any loss shall be allowed, but whether any other income held, there is a loss that can be set off against the income from virtual digital asset. Is it possible? Or secondly, if I have loss from one virtual digital asset and there's an income from other virtual digital asset, can I do a set off from these things? So this clarity is not there in the budget. And another thing is, in the virtual digital asset, they have defined under section 115 BBH. So this section comes after the section 115 BB. So 115 BB generally talks about the taxation on the lines of lottery, betting, and gambling. So this 115 BBH talks on the virtual digital asset. So this will come under definition of income from other sources, or this will be falling under the capital asset, because they have not defined the virtual digital assets or crypto under the definition of section 240. There is a separate definition 247A. They are defined separately. So what is the thought? So one school of thought is that it will be taxed from income from other sources, and another school of thought is like this is nothing but a capital asset, so it might be taxed under the head of the capital assets. So one more thing what we need to look into is like what will happen for the previous years, like if they have disclosed the crypto assets in previous financial year under the capital gain, and they have taxed as long-term capital gain or short-term capital gain, maybe long-term capital gain based on the period of holding. If it is held for more than 36 months, it will be treated as long-term capital gain. If it is held for less than 36 months, it will be treated as short-term capital gain. So when we are disclosing the earlier years as capital asset, now if I'm going to disclose in next year as income from other sources, or I need to maintain a consistency by disclosing under the income from capital gains, all those things are like little bit dicey because they have not clearly spelled out how the things will be taxed for the cryptocurrencies. We have to wait for more circulars or more clarifications from the department on the virtual digital asset, because Sitharaman, while delivering the speech, she clearly told like we want to tax the virtual digital asset, but they never told whether this is a legal thing, whether it is an illegal thing. They have not come with any clarification as such. See, all this gambling and all those things are even not legal. So in the same fashion, they are saying we are going to tax. The main motive of the government here is to get the revenue. So they want the revenue. They want to tax the virtual digital assets. So this is the main thing on the virtual digital asset. So they are moving towards, this budget is moving towards the revenue mobilization. They want to collect more revenue from the people, because if you see these Bitcoins, this Ethereum, these Dogecoins, these are all a new concept, not new concept. It came a decade back in 2009, and at that time the Bitcoins and all those things were purchased at $1. And now if you want to purchase that Bitcoin and Ethereum, for the cost is around 30 lakhs or 40 lakhs. So it's a huge cost. Like people want to buy it in pieces, or they want to go into this virtual digital asset, and how the stability will be, because we don't know. There are a lot of questions whether it will be stabilized or it will not be stabilized.
Absolutely, Prakash. So I think moving on, I think you've put the cat among the pigeons insofar as virtual digital asset transactions. We are definitely not heard the end of it. There would be a lot more said and litigation around this, because you are right in terms of the consistency and the treatment in the previous years, and the whole challenge around retrospective interpretation of this will arise. What if in the previous year you submitted your tax at 20%? Is now that going to get reopened at the time of assessment? And how it's going to be treated? There are challenges which remain. You're absolutely right. But let's shift gears to another aspect which I brought out, which was the education cess and the retrospective disallowability of education cess. What is your view on that?
Yeah,
that's a very hot burning topic these days in the tax circle, especially.
See, whenever the government says we are not going to bring any retro amendments, okay, they will come with a policy of the retrospective amendments. Now, this is also a retrospective amendments. This was because this education cess and a surcharge was introduced in financial year 2004-2005. Okay, so generally, if you see section 48(2) generally says income tax paid will not be allowed as a deduction. So income tax, on this income tax, there are surcharge and there is education cess. So one school of thought always is that this forms part and parcel of the Income Tax Act. So this will not be allowed at a deduction. So there were controversies, there were rulings. They took the decision based on the circular saying that this is not part of the income tax. This is a kind of charge, and this should be allowed as a deduction. In the Sasa Goa case, the Bombay High Court told that it should be allowed as a deduction. So to just put all the end to these controversies, they have come with a clear amendment: no more allowing of education cess or surcharge. This will not be allowed because this is part and parcel of your income tax. As 48(2) says, income tax will not be allowed as a deduction. This education cess will also not be allowed as a deduction. That is the clear-cut thing which has been put by Sitharaman, saying that no more controversies. We want to reduce the litigation. We have seen a lot of litigation. Whenever something comes into picture, people will come with their own case laws and with their own interpretations. No more interpretations, nothing doing. We want to reduce the litigation. We want to reduce all the costs. So this should be settled down, and this education cess and surcharge will not be allowed as a deduction. So this is the second thing. Now coming to other thing.
So I think, Prakash sir, we are going to, in the interest of time,
okay.
The last point that we had, let's see if we can try and keep it very brief. The last point before we switch to GST is on the marketing expense and the allowability of marketing expenses of pharma sector.
Pharma companies,
I think there was a recent judgment only last week also which had come out on that topic. Yes. And there were, this is also now in the budget. So in light of that judgment, which was, I think, against the SSC pro revenue judgment, what is your view? Do you think that this is the last of the controversy, or do you think that this controversy will continue? So very briefly, if you could share your thoughts. Thank you.
Yeah. See, there was a clear-cut CBDT instruction where they relied on the ICMR regulations, Indian Council Medical Regulations, where they told any freebies or anything which has been given to doctors which are engaged, like the pharma companies or the allied sectors used to give freebies to the doctors, maybe travel facility, hospitality expenses, maybe sponsorship expenses. There was a clear-cut instruction from the ICMR saying that these expenses will not be allowed. But the CBDT also came with a circular saying that these expenses should not be allowed because these are prohibited by law. Even though it has been prohibited by law, you are going ahead and giving these facilities to the doctors, which is not in line with the pharma industries. So they clearly came with section 37 where they told even if you're incurring this kind of expenses, this will not be allowed as a deductions. But the courts went ahead and decided in other way. So now the budget has come with an amendment saying that nothing doing. If you have incurred any expenses which is provided to doctors as freebies, maybe travel facility, maybe hospitality, maybe sponsorship expenses, or under the Indian law or the foreign law, any law, whatever the law is there, which has been prohibited by law, if you're going ahead and providing, then this will not be allowed as a deduction. So section 37 is very clear with this thing, and this once again is the step for the rationalization, and once again we want to reduce the litigation. So this is the last thing which I want to discuss.
Thank you so much, Prakash. That was very informative. I think we quickly managed to talk about 3 hot topics on virtual digital assets, on the education cess retrospectivity, as well as the pharma industry woes around the marketing expense. So next we have Nitish ji, who's going to talk about GST and that. So I hope you guys are all ready. So Nitish ji, my question to you that, what are your viewpoints on the budget impact on GST changes, including in ITC and refund of taxes? I know that's a big issue. Most assessees and most of our viewers today would be, quite harrowed with getting refunds from Government of India, and especially on getting, the input tax credit. So your views on that? Is there any relief to the assessees, to the common man when they get their refunds and getting the ITC credits? Over to you, Nitish sir.
Thank you, Raghuji. The way it's been like 2017 and we are at 2022. If I take it that it's been the 5th budget. However, we have the GST council. Given this, the 2 aspects attached to it is indirect taxes, which I take it as customs, right? Well, that's supporting the Make in India part aspect to it. The GST part is something like, I started when my room was square. Now I'm accommodating more, making it as an L shape. Maybe that's the trend. Now I'm stretching the L a little further. There have been a certain amendments which has taken place in this section 41 that proposes to levy interest on the recipient for the errors of the supplier. Such amendment is contrary to the rulings of the Honourable Supreme Court in the case of Arise India and Madras High Court in the case of DY Patil Enterprises. What was held in that the recovery of ITC from the recipient cannot be sought without first exhausting the remedy of recovery proceedings against the supplier, as collected GST from the recipient but failed to deposit the same with the exchequer. Now, this proposed amendment would be appreciated by the taxpayer in as much as the existing provisions do not permit for revealment of ITC in the prescribed manner pursuant to payment made by the supplier. Now, there has been a matching mechanism of ITC also. What happened in this case? We had a section, which section talked about a particular return. Now, we didn't have the process attached to it. Now, what did this section entail? And then why was this section subsequently taken away? Now, the existing provision of the Act, the recipient had the option to modify, reject, accept the details furnished by the supplier by filing GSTR2. Now, with the proposed amendment, the requirement of filing GSTR2 has been done away with, and the recipient can avail credit based on the details provided by the supplier of goods and services. Further to that, there had been a further, going with the ITC point of view, Section 16(2) of the Act prescribes a condition for availment of ITC for the registered person. A new condition has been proposed. Now, by introduction of Section BA, providing that ITC would not be available if the same is restricted in the details provided in GSTR 2B under Section 38. Additional restrictions further has been imposed. And this is in Saratim, if I probably say, newly registered taxpayers, regular and continuous defaulters, defaulters of self-assessed tax, supplier availing excess ITC, supplier utilizing excess ITC, and so on and so forth, means as may be prescribed. Further regulation has been come. There has been auto-generated statement that would be there. Now, this provision introduced for claiming ITC based on auto-generated statement in GSTR 2B, which shall comprise of 2 parts: inward supplies for which ITC is available, and inward supplies for which ITC is not available, either wholly or partly. Coming to your second aspects to it in terms of measures in relation to refund. Certain amendments have been proposed in that too. For refund of balance in electronic cash ledger, an application needs to be filed in a prescribed form. Now, at present, it is linked with return filed under Section 39. There have been a further amendment in Section 5410, which extends the scope and power of the authority to withhold all types of refund claims. Now, at present, such restrictions is applicable only to refund claims on account of zero-rated supplies and inverted duty structure. Well, this is something which, for the inter-unit transfers, or the industry is going to like it. There has been a provision in respect of transfer or balance of electronic cash ledger between distinct persons. And it's a welcome move, as the SSC will not be required to face the hassles of the refund. Further, interest on delayed payment. Now, this has moved to ITC wrongly utilized. Earlier, it was availed. And I always probably say that, GST being a dynamic law, the 80-20 ratio or a 60-40 ratio. Now, if it's 80-20, I know it at a particular point of time, I'll get the justice. Now, where does it comes from? It comes from the erstwhile legislations in terms of the indirect taxes this way is. So this proposed amendment is in line with the erstwhile provisions of Rule 14 of the Standard Credit Rules and judicial precedents, in case of Maruti Udyog Limited and Bill Forge Private Limited. There's another welcome step which has been taken in terms of the existing provisions. You have to pay 24% interest applicable in the case of availment of unmatched ITC. Pursuant to the amendment, the taxpayer can explore an option of claiming refund of differential interest of 6%. It's 24 minus 18. Raghuji, I guess that speaks about the ITC part and the refund part attached to it.
So Nitishji, I think, thank you so much for that. I think we will move to the next question, which is the custom changes and the SCZ Act, the replacement of the SCZ Act. And there are certain custom changes which are supposed to have a lot of impact, including some advanced rulings. So would you like to share, to break it down for the common man, because the moment we get into sections and we get into too much legalized language, people, so we're trying to simplify it for them. So in simple terms, how would you say that some of the custom changes and the SCZ Act changes are going to make life simpler for the businessman and the founders who are operating in these SCZs? Over to you, Nitishji.
I would just touch upon the two aspects attached to it in relation to customs, where probably business needs to look through a very close lens. One is the DRI part, another is in terms of the valuation of goods. Now, DRI, this amendment was anticipated as a massive revenue of the government was at stake post a decision in Canon India, which was followed by a High Court and tribunal to quash show cause notices and proceeding initiated by the DRI officers. Now, the department plea of review petition pending before the Supreme Court was also not heeded. In fact, in August 21, the Supreme Court, again in Agarwal Metals, proceeded to quash proceeding initiated by the DRI. Now, what was the direct impact of this amendment would be on the outcome of pending petitions and appeals, where the jurisdiction of DRI officers to issue show cause notice has been challenged. Now, these amendments to challenge the constitutional validity retrospectively validate the past actions of DRI officers is barren law and without jurisdiction. These amendments will also see intense litigation till the Supreme Court finally decides on the issues. The second aspect which I mentioned about was the valuation of goods. Now, where this coming from is this amendment has a far-reaching implications and appears to have been introduced in the hindsight of the decision of the Honourable Supreme Court in the case of Century Metals Recycling. It was held in this that the formation of opinion regarding reasonable doubt on correctness of value is mandatory before rejecting transactions value under Rule 12 of the valuation rules. Such findings were merely premised on the interpretation of the term reason to doubt instead of the term reason to believe. So why this proposed amendment? What the government would now prescribe to set a rules to include such circumstances where valuation can be doubted on the basis of reason to believe. Now, one will have to wait and watch to see the exact nature of amendment to the valuation rules to understand the consequent impact. You mentioned about, the spatial economic zones. I referred about it, we're making it a square to the L shape now, and probably now one of the French architect would come and say, the L is out of fashion. Fashion states the style is internal. So that says FM announced the Spatial Economic Zone Act in 2005. Now, this will be replaced by a new legislation that will enable the states to become partners in development of enterprise and services hubs. This move is intended for large existing and new industrial enclaves to utilize available infrastructure and enhance competitiveness of exports. Now, it remains to be seen how the new legislation will overcome the hurdles that plagued such a land acquisition, site selection, connectivity, and so on and so forth. This announcement probably follows the recommendation of the SEZ Policy Review Committee. This committee, to the best of my memory, submitted its report in 2018 and recommended the setting up of employment and economic growth enclaves in place of SEZ. So we'll have to wait and watch. This is going to be somewhere on 30th of September, and this year we're going to have the new legislation.
So much for that, Nitishji. I think this was very informative, and it just, from a layman's point of view, it seems that every legislation seems to override a judicial pronouncement which may be pro-assessee and anti-revenue. And that seems to be the theme, whether in income tax that Prakash was talking about earlier, or in GST or in customs. It seems to be a common thread that whenever the courts in India come out with an anti-revenue pronouncement, we very quickly have the legislator overriding through an amendment in the law. So fortunately or unfortunately, like I said, this is how jurisprudence goes forward. With that, we're going to touch upon the Q&A. There is a question which is based on Mr. Nishant Arya's submissions, and I think since he's not here, I'm going to try and take a jab at it and then ask maybe Nitin to share his views on it. So I'm reading out the question. As Mr. Arya said, today EV is the best substitute technology to conventional oil-run vehicles. But the resources utilized in manufacturing EV batteries and certain other components are just less harmful compared to the impact on climate by oil-run vehicles. Therefore, over the past centuries, have we just developed a less harmful solution than developing complete green solutions? This further leads me to ask, will the world in the next few decades again turn to finding a greener substitute to use of batteries? So absolutely yes. I think this is, we're trying to go forward by reducing carbon footprint from oil-based, vehicles to something which is, a little bit in the right direction in terms of a lower impact on the environment. But yes, as newer technologies come in, like green hydrogen, Nishant was talking about, or other technologies become more practical, definitely we will have more efficient substitutes for even batteries. Nitin, would you like to share your thoughts, or, are you comfortable with that response? Over to you, Nitin.
Thanks. No, I don't think this is a solution. It's not exactly, this is something that the world is anyways moving towards. So I don't think people should consider it as a retrospective solution towards a better. We have no option. We cannot be relying on traditional forms of energy. We have to, as a world and India and everyone, we have to look for other alternatives of energy. And I think its time has come, and this is just the start. In 20 years down the line, I'll be very happy to see if in Delhi we have cycling, traditional paths, we have sharing of vehicles, we have pools, we have green energy technologies. Currently, many European cities are following that model. It's really a pleasant experience when you visit these cities, and it's all because of pollution and using fossil fuels. So I don't think it's a solution. I think it's required for everyone, as an investor, as a country, as a society. And the costs will keep on decreasing as the technology keeps on getting more common. That is a factor in everything.
Absolutely. Thank you for that, Nitin. And with that, before we close for today, I'm going to quote Mr. Rabindranath Tagore, the famous poet, who said, "Faith is the bird that feels the light and sings when the dawn is still dark." And with that message, we need to all remain positive, hopeful, and happy, even though we may have COVID and we may have geopolitical wars and other pressures at home. I think that is the message that RNM India wants to give out to the world, that please remain positive and remain safe and remain blessed. And with those words, I want to thank all the panelists for sparing their valuable time, and all the viewers out there. Thank you so much. Namaskar and Shabba Khair.
Thank you.
Thank you for having us. Thank you.